Hey everybody, this is Tim Dial with Nexa Mortgage, and I am going through right now and putting together this video presentation. This is going to be a slideshow, a whole presentation about the 2025 forecast. I've been wanting to do this for a few days. This came out through, I have a subscription to MBS Highway, and they went over all of this data with us a few days ago in their own presentation, and I wanted to be able to present it to the people that I work with or do business with to give them an idea of what's kind of coming for this year. There's a lot going on. Obviously, there's a new administration. We've had high rates for a long time, and there's a lot of stuff going on in the market that's going to change things throughout this year. It's going to cause some differences in interest rates and things like that. So I wanted to get into the details and the nitty gritty. I have removed a few of the slides that I think are just too technical, and I just didn't really want to go into a lot of these technical details. But there's some of it that really does make sense, and I think a lot of people will enjoy kind of seeing. So what I'm going to do right now is I am going to go ahead and share my slideshow screen here, and then we can kind of get into this. Okay, you can see my screen here. You should be able to, where it says 2025 forecast. Additionally, this presentation does put my words here at the bottom whenever I'm speaking. So in case somebody has trouble hearing something, they can see it down here at the bottom. But I'm going to go ahead and get into this and kind of go through it. So let's go ahead and move forward here. So this is the 2025 forecast for the Fed. This is kind of what they're forecasting. We're going to get into that here real quick. If you look at these dot plots here, these are basically Fed members and what the Fed members believe are going to happen this year. Currently, we're at 4.375. Fed's already had their first meeting and they didn't make any cuts or anything, so they kept us at 4.375. But they are projecting at this point, 10 members are projecting 2 cuts during the year. Cuts are normally 25 basis points, so that brings us from 4.375 to 3.875 on the Fed funds rate. And keep in mind that the Fed funds rate doesn't directly impact mortgage rates. It does impact mortgage rates indirectly normally, but not directly. There are a lot of other factors that go into mortgage rates. So keep that in mind. We've actually, last year we had 4 rate cuts and rates actually went up since the time they made it. We had the first rate cut in September. Rates are higher now than they were in September. So that it doesn't directly impact, but over a long period of time, it will indirectly impact the rates. So keep that in mind. Now, there are obviously some members who believe there will be less cuts, and there are some members who believe there will be more cuts. And so we'll get into why they have this current reasoning right now and why we think they're wrong on what they'll end up doing. So we're going to get into that as well. Yeah, if you look at the Fed forecast, right now they're looking at unemployment rate this year being 4.2 to 4.3%. This is what the majority of them believe where the unemployment rate will remain. I believe this first Fed meeting, they said it had dropped to 4.1. But we believe that this is going to go up. So there are 5 members who believe it'll be 4.4 to 4.5. If this does happen, they likely will make more than 2 cuts. They likely would make 3 to 4 cuts in this range. We believe there's a decent possibility we could end up here at 4.6 or 4.7. If that happens, they will make more than 4 cuts. They will probably make at least 5 to 6 cuts, and they might even make 1 or 2 cuts that are higher than 25 basis points. You could see them do a 50 basis point cut if unemployment goes this much higher. As you can see, there's not a single Fed member that believes we'll be this high on unemployment. So if this happens, this will surprise every single member, and you'll see them be much more aggressive on their rate cuts. So yeah, 4.6% would surprise all 19 members, and then you'll see some really big moves. So 4.4% would surprise 14 out of the 19 members, and they'll definitely make more than 2 moves if that happens, because they are very concerned if the unemployment rate goes up too much. They're concerned that that's going to bring us into a recession. So that's kind of what we're looking at here. So the next thing I want to look at is the forecast for 2025 inflation and what they're kind of looking at and what we think is going to happen there. So if you look right now, they have the core PCE, which is their favorite measure of inflation, at 2.8% year over year. And that was as of November. I believe when they just had their meeting, it's still at 2.8%. When they just had the meeting like over the last day or two, they still have it at 2.8% year over year. We believe that it's significantly overstated, and this is because there are certain factors that are delayed a great deal, and they're not factoring those delays in. So the biggest thing is the shelter component, and they did mention in the meeting that shelter makes up a big part of why they're having trouble getting this inflation reading down. But they didn't acknowledge that there's this delay effect, and that the delay effect means that our real PCE reading should be lower. So, and we'll show you why when we get into the meat of the numbers. So CoreLogic rent index shows us at 1.7% year over year on the shelter component, but the PCE is including 4.8% year over year because their data is so far delayed. Shelter makes up 18% of the core. This is overstated by 3.1%, and you're talking 18% of the 3.1%. So if you take the 4.8 minus the 1.7, you get the 3.1% overstatement. Multiply that by the 18% of core. That gives you an overstatement of 0.5% that is built into this, which means that the true core PCE should be at 2.3% right now if they didn't have this lag. And unfortunately, this is what the Fed does all the time. They're always dealing with old data, and that's why they always react too late. When the inflation went up, they reacted probably 4 to 5 months later than they should have, and as a result, that's why we ended up with inflation for too long and why it's just been persistent. Now they're likely to react too late as well, which could lead us to a recession, higher unemployment, etc. So so core PCE should currently be at 2.3% without that shelter lag. If we were at 2.3% right now, they wouldn't be looking at 2 rate cuts this year. They'd be looking at least 4 to 5 rate cuts this year, guaranteed. So that's a big difference. That's one reason why we think they'll end up doing more, because once this shelter lag catches up, we're going to see this inflation number come down. And this just gives you more of like a chart that shows the monthly shelter readings in PCE and how that's come down over time and where we are at this point, November of 24, where we were. So it just keeps coming down, and that has continued into this year as well. And the other thing that they're not really taking into great consideration are the replacement values within shelter. There are a lot of replacement values. So what they look at when you're talking about inflation, you're looking at this year versus last year. And the shelter component has a replacement value. It's like what we were last year versus what we are this year, right? And so if you look at this core PCE reading, right, December of 2023, the replacement value is 0.182%, which is really low. So whenever we replaced it with I think it was like a 2.2% number or something, it actually went up a little bit. But that 2.2% or so number is going to stay about the same. And next, we're going to be dealing with these types of replacement numbers, especially January. So January, you're going to see a decrease in the core PCE just from the replacement numbers of 0.2 or 0.3% just by itself. And so that's kind of how that looks. So when you look at annual inflation versus cumulative, the red line is the consumer price index for all urban consumers. Right. So this is what has been happening with inflation over time. You see it was way up here and then it came way down. The blue line is more what people feel, right? So it's a cumulative effect, more what people feel. So what happens is when prices go up, they don't come back down. They go up. They just go up at a slower rate. And that's why inflation is lower now. It's in the 2% instead of in that 9 or 10% like it was. But we didn't lower the prices from that 9 or 10%. We just added to it at a slower rate. So people are still feeling the effects of the prices going up so much during those first few years. And so that's why you see this big difference here. People feel like inflation is up here, even though it's way down here. And that's because of the cumulative effect of inflation over the past 4 to 5 years. Inflation has gone up a lot as compared, if you look at prices where it was 4 years ago, prices are a lot higher today, even though the current inflation rate is in the 2 to 3% range. People feel like it's in the 15% range because they're looking at a 4-year inflation rate, right? So that's why people are so negative when it comes to prices, because prices are so much higher than they were a few years ago. So I wanted to get into that a little bit. Now, the next thing is that we want to look at is the 2025 forecast for labor and kind of how that looks. So let's get into that for a minute here. If you look here, January of 2023 through November of 2024, this is the unemployment rate. It went from 3.4, and at one point it peaked out at 4.3, and now it has come back down. Here it was at 4.1, it went back up to 4.2, and then at this last meeting, it came back down to 4.1. So that's kind of where we're at. That's why they think it's stabilized a bit up here at the 4.1 to 4.2, because it's been there for a few months now, and it's kind of stopped rising to some degree. But we believe that that's temporary. The other thing that's happening here is that when they're looking at the unemployment rate, they just look at whether somebody's employed. They don't look at what type of job they have. And one thing that has been a phenomenon is if somebody loses a really good full-time job, and then they go out and they pick up, say, an Uber job, which has been very common, that's a 1-to-1 ratio. They'll say, well, there was a job lost and a job gained, so the unemployment rate stays the same for that person. The problem with that is that you're losing a really good full-time job and you're picking up this job just to try and make ends meet. You're in a worse financial situation. Sometimes those people have to pick up 2 jobs. And if that person picks up 2 jobs, that's actually a +1 within their unemployment rating. And it makes it look a lot different than it really is. That's not a sign of strength in the economy. That's a sign of weakness. So some of their data is wrong on the unemployment front as well, because of the types of jobs people are losing versus the type of jobs people are gaining. And here's another graphic that kind of tells what's happening on a larger scale in the country. If you look here, store closings, where people work, store closings are up 70% in 2024 versus 2023. So that tells us that the unemployment rate should be quite a bit higher than what they're showing. It's just they've got bad data. And so if you look here, these are the stores that have closed. Party City, 850 stores. Big Lots, 580. Family Dollar, 700. 900 CVSs have closed. Advance Auto Parts has closed 727 stores. Walgreens has closed 1,200 stores. So these drug stores are just going away like crazy. And then you just go on and on and on with all these different closings that are happening. Foot Locker, Express. Some of these are mall stores, and of course malls have not been doing well as everybody's buying online now and stuff like that. So you see just tons of store closings taking place. Up 70% within 1 year is a huge amount. And so I think this definitely shows a sign of weakness in the economy. This is the JOLTS job openings, right? At one point back here in April of 2022, we were at 12 million job openings. Now you see this coming all the way down to 7.7 million in October of 2024. So it's been a steady decline in job openings. Once again, that shows weakness in the economy. Unemployment rates should be rising more than they're showing. So the next thing we're going to look at is the 2025 forecast for mortgage rates, kind of get into that a little bit. This is something that probably most people feel like is kind of the most important thing over the next year. That's something that we're certainly looking at very closely. If you look at the 10-year Treasury, The 10-year Treasury moves the same direction as rates. So as it goes up, the 30-year interest rate goes up. As it comes down, the 30-year interest rate comes down, and so on and so forth. So that's what we're looking at here with the 10-year Treasury. We came down like right here in September. We were at a pretty good place on 30-year mortgage rates. They had come down a lot, and we thought that that would continue. That's when the Fed first started cutting rates. But instead, as you can see, we've just gone up, up, up. We had a little bit of a help here in the November, December timeline, and then up, up, up again. Now we've started to see a little bit here at the beginning of the year. We've started to see a little bit of relief here in January so far, but we need a lot more. We need it to come down a lot more. And so we're going to get into that a little bit here. Where could mortgage rates go? And this is kind of our projection of how we think things are going to go this year. There's a spread between the 10-year Treasury and the 30-year fixed mortgage rates that should continue to narrow. We should see this continue to narrow. And so this is what we're expecting within the next 6 months. 10-year Treasury, 3.6%. The spread narrows 2.25%. And the 30-year FRM rate, you add those together, you get 5.85%. So this would be the fixed rate mortgage, 30-year fixed rate mortgage. So we're expecting that to come down. Right now, the 30-year fixed rate, depending on whether you're doing FHA or conventional, right now it's somewhere between 6.75 and 7.25. And to some degree, that depends on the customer's interest rate. And also, like I said, the FHA is a little bit lower as far as their interest rate than the conventional loan, and that's true with VA as well. VA is a little lower as well. So, but this is an average of the two. We're looking at about 5.85% within the next 6 months. This would be very welcome within the market. This would put us below where we were in September, and we'll see a lot of refinance activity. We'll also see a ton more buyers come on the market to buy homes. And that will drive prices up in the housing market because if you have a higher demand for homes, there's going to be more competition for those. There's only so many available, and prices will rise rapidly. That's what takes us into the next part of our presentation here, which is the forecast for real estate for this year. So if you look here, look at the U.S. housing market. Out of 136 million households, there's 45 million renters, 91 million who own, and this is gives you an idea of the equity, right? The people renting have zero equity because they don't own. The owners have an average of, or have 37 trillion in total equity, and the average is about 407,000 per household in equity. So that's a lot of equity, and this gives you an idea of why it makes so much more sense to get out of this renting cycle and get into this owning cycle. Because how can you get your equity up to this amount if you don't own a home? You can't. You're just throwing your money away. Plus, the people who are renting have no control over how much they're paying for rent. The landlords just up it all the time. Whereas if you own, you have a fixed rate mortgage, it doesn't go up. As a matter of fact, it'll go down because once the interest rates drop, you can refinance and lower your mortgage. So that's kind of how that works. This gives you a little bit more of a breakdown. 35 million of these owners, of these people, 35 million of them are free and clear, meaning they don't have a mortgage. And that makes up 571,000 per household on average of equity. The ones who have a mortgage, that's 56 million, but they still have 311,000 in equity on average. So there are a few that have a negative equity. As you can see, you're 0.3 trillion. Now, negative equity is extremely rare, but that generally happens because someone maxes out their mortgage, and also you could actually have negative equity when you first buy a property. A lot of people don't realize this, but it's possible. Just to give you an example, if someone does a USDA loan or a conventional loan, a USDA loan or a VA loan, those are 100% financing, meaning you don't have any equity. Plus, USDA will add a 1% fee on top of it. So you're at negative equity when you first move in by 1%. Additionally, with VA has a funding fee that's dependent upon your military service and things like that. And whether you're on disability, there's several factors that go into it. But VA has a funding fee that they tack on as well. So some people who do 100% VA or 100% USDA have negative equity when they first move in. There are also people who use down payment assistance that have negative equity when they move in. Give you an example, FHA requires a 3.5% down payment. And there are some people who buy a home who use a down payment assistance program that gives them 5%. 3.5% of that 5% goes toward the down payment. The other 1.5% they can use for closing costs. And so when they first move in, they have a 1.5% negative equity. So because that 5% that they're getting, and that down payment assistance only provided 3.5% for the down payment. So there are negative equity situations at the very beginning for some people, and that's what makes up the majority, if not all of this. Very few people have purchased a home and then the home lost value, and that created negative equity. That's something that was more prevalent back in like 2008, back when we had the financial crisis. There was a ton of negative equity out there because values dropped when all the foreclosures happened and stuff like that. So we haven't seen that since. So anyway, when you look at active listings and what's happened there, this just gives you like a chart from 2017 to 2024. It kind of shows there's been this up and down of active listings. And this has a tendency to be seasonal to some degree. People don't like to have their house listed during the holidays and stuff like that. Activity picks up in the spring and summer, and so you end up with this type of chart. But it got way down here in January of 2022, and then it has gradually gone up since as people have become more and more used to the rates. All right, and then and if you look here, from July of 2023 to July of 2024, there's been a 27% increase in active listings. That is a big jump just within the last year. And then we're expecting that to jump again this summer, especially if the rates continue to go down like we think they will over the next 6 months. And then when you look at from 2018, from 2018, which is right in here, you see there's been a big 21%, decrease overall in active listings. So overall, the active listings has gone down over the past, 4 years or so, or is it 4 years? No, more like 6 years. The active listings have gone down within that 6 years, but over the last year, they've started to spike. So it gives you an idea of what's going on in the market over a long period of time versus a short period of time. And during this time from 2018 until today, the population has gone up by 12 million, right? So when you have a decrease in active listings, but the population's rising, that means you're going to have more demand than you have supply. And that's what we get into here. So this shows right now, demand is 1.915 million for homes, right? And the starts are at 1.289 million for supply. So as you can see, there's a big difference. There's a 0.7 million difference, demand over supply. And that's considering that demand is down right now because interest rates are high. But this is the reason why prices have continued to rise even amongst the higher rates, because you have this difference in supply and demand. So prices have still gone up by 3 to 4%. And that's going to increase on a year-by-year basis once the rates come down, because that demand is going to go up by even more. And we don't see supply. Supply will start to catch up some. There will be more builders building homes, but it's not going to catch up quickly enough. So here's the real estate forecast we're looking at for 2025. We're looking at 4.1% year over year as far as the price is rising. So on a $500,000 home, that's a $20,500 gain in 1 year. 5-year cumulative, that's 30% to 35%. So a $500,000 home, you're going to gain 150 to 175,000 in 5 years in equity. And that's kind of what we're looking at as far as the current forecast for the 2025 year. And I think that as the rates go down, you might even see that 4 point whatever percent go to 5 or 6% within 26 or 27. You're looking at that 5-year possibility. You could see some bigger increases than that. All right, so core PC inflation 2.1 to 2.2% from that 2.8% figure right now. Home price appreciation 4 to 4.5% year over year. Unemployment rate 4.5 to 4.6% from that 4.2% number. If all of these things happen, the Fed will definitely make more than 2 cuts, no question about it. Fed funds rate we're thinking will be 3.25 to 3.5. And mortgage rates declined to 5.75 to 6% from currently around 7%. So that's kind of what we're looking at as a possibility for this year. I could even see this coming down more because this is based on just these numbers that we're seeing and what we think the Fed will do. But these numbers could potentially lead us to a recession. And if we hit a recession at some point this year, and if the Fed comes out and announces a recession, they will make more than 4 or 5 rate cuts. They'll make 6 to 8 equivalent rate cuts. Some of them might be 50 basis points, but they'll make more rate cuts than what we're looking at here if we actually go into a recession. And then you would see this interest rate come down potentially to 5.25%, maybe even 5% or lower by the end of the year if we do actually enter a real recession. So anyway, that's kind of what we're looking at right now. That's what I wanted to kind of go over here. I didn't want to take an immense amount of time. I wanted to get through it relatively quickly. The presentation I went through was probably twice as long. They got into the weeds in a lot more detail, but I think you get the general idea of kind of what we're expecting. I have several people that are wanting to refinance when it makes sense, and I have kept them on hold because I know this stuff's coming down the pike, and that it's going to make more sense over the next 6 months to refinance than it does right now. And so we're just kind of waiting for the right timing. But once those rates get down there to 6% or lower, there's a bunch of people who it's going to make sense for to refinance who are in that 7 to 7.5% interest rate range. Some people who are like 6.75 will be able to refinance within the next 6 months as well, I think. So it just depends on where you are and things like that. But, that's something that, always reach out to me when you want more information on this stuff and kind of where rates are and where they're going. Feel free to reach out to me anytime. There's my office phone. You can also reach me on my mobile, which is 615-995-2615, or my email address is tdial@nexamortgage.com. I'm always here to help, to answer any questions, make sure you're updated on the market. And you can also subscribe to my channel because I'm always giving updates on here at times when it makes sense. Every time there's a Fed meeting, I give an update, and then I give updates in between if there's something significant going on in the market that I think people might want to know about that's impacting the interest rates. So that's pretty much it. If you have any questions or anything, let me know, and I hope you have a great weekend. Thanks.